April is often described as one of the strongest months for equities. This is something that is regularly highlighted in financial media, with analysts pointing to historical data showing relatively strong average returns in the month of April. But as always with seasonality, the important question is not whether a pattern exists, it's how reliable that pattern really is. So if we look at the S&P 500, over April, across the last 25 years, we can see why this reputation exists. The average return tends to be positive at 1.20%, and many years, as you can see here, show a constructive performance. But the picture is not as clean as the headline suggests. If we compare the last 5, 10, and 15 years of the pattern, we can see some very interesting information. So in the last 5 years, we can see that the average profit has actually been negative, with an average return of 1.94% over these last 5 years. Now, if we go back to the data, we can see that that was largely driven by 2022. The S&P 500 experienced a major sell-off, marking its worst April performance since 1970, and the index fell over 8%. It was driven by a combination of high inflation, aggressive interest rate hike expectations, and disappointing corporate earnings, particularly in the technology sector. However, if we remove that data and we select all these years and just remove the 2022 year, we can see that that pattern changes, and that also lifts the average return generally. So this highlights an important principle in seasonal analysis. A strong average return does not necessarily mean consistent performance. And in fact, a positive average can sometimes be driven by a relatively small number of strong years, while other years may be weak, volatile, or even negative. So the question becomes, is April strong or just occasionally very strong? So this is where consistency matters. And in seasonality, a low standard deviation is usually preferable because it means the historical pattern is more reliable, not just occasionally spectacular. If this standard deviation number is high, the outcomes are less predictable, even if the average looks attractive. So if we look at the variability of returns, the picture becomes clearer. Over the last 25 years, the S&P 500 shows a standard deviation of around 4.8%. That's not especially low, which tells us that while April may have a positive average return, as we can see it clearly does, the range of outcomes from year to year is quite wide. In seasonality, a lower standard deviation is usually preferable because it means the pattern is more consistent, not just occasionally strong. So what we're really seeing is not a smooth seasonal trend, but a month that can deliver strong performances in some years. So April's strength is real, but it's not necessarily consistent. Now let's look at the NASDAQ 100. Now looking at the NASDAQ 100, we also see similar behavior with strong years, but also meaningful variations. In terms of the standard deviation, we have a much higher figure of 7.66%, which tells us this is a month with larger swings, greater dispersion, and less predictability. That's a significant difference to the S&P 500. So it tells us that while April may have a positive average return, the consistency of outcomes varies substantially depending on the index. So again, we can see the difference between the S&P 500 and that standard deviation between the 1st of April, 30th April versus the NASDAQ 100 standard deviation. Now in the DAX, we see a different picture again. April is the strongest month of the year, over the last 25 years, got average returns here of 2.45%. Now, the DAX is interesting because the average return is strong. The standard deviation, however, is still elevated at 6.32%. So it sort of sits between the S&P 500 with its standard deviation here and the NASDAQ 100, 7.66%, and the DAX sits in the middle. It sort of does deliver a stronger average return with less variability than the NASDAQ, but more variability than the S&P 500. So what this tells us is April may offer opportunity, but the consistency of that opportunity varies across markets. In the S&P 500, the variability is moderate. In the NASDAQ, the variability is high. And in the DAX, we see a combination of strong returns, but still meaningful volatility. So this reinforces a key point. And this is why Seasonalty's data is so useful. The April effect is not uniform across the market. Financial media can often point to several structural explanations for April's strength. It can be the easing of tax-related selling pressure, new capital allocations after the first quarter, pension and fund inflows, stabilization after early year volatility. And these factors can create supportive conditions, but they're not guaranteed to dominate every year. And when April does underperform, as we saw in 2022 here very clearly, it tends to be because of macro conditions will often override seasonal flows. So big interest rate expectations shift, earning expectations changes or disappointments, risk sentiment can weaken. In other words, seasonality is also conditional on the broader environment. So how should April seasonality be used? So it's not as a signal, but as a framework. It can help you ask, does the current market structure support the seasonal tendency, or is it likely to override it? April has historically shown strong performance for equities, but strength does not equate to reliability. And that's the key takeaway. Seasonality is not about finding guarantees, it's about understanding probabilities and knowing when those probabilities matter and when they don't. And Seasonax helps you make those decisions with more information.